today's the 12th. I can't believe how quick this semester is going. Guys, midterms look pretty damn good. I got everybody's grades in. All the testing is done. I got to go back and look at the test average now. And if we have a solid B, then we're going to talk about online testing for the rest of the semester. Does that make your Monday better? If we would do that, would that make your Monday better? Yes.
How many total tests do we have?
Most likely 3 in person. You're going to have a test after our next couple chapters, then you're going to have a final, which is not cumulative. So all the tests in here are like normal tests. You got it. You got it. Now what I occasionally will do, if there's some material I want to cover that we didn't get to in class, I'll do an online open book, open notes test, and that allows you to boost your grade. Yeah, not the most you need to worry about. So guys, in terms of the Chapter 3 assignment, which I finished grading, that was not included in your midterm grade. And guys, there are still plenty of opportunities for bonus points in this class. If anybody wants to come up and do a presentation, for example, you can still come up and lead a discussion or have a presentation. We're going to be continuing Chapter 16 today, guys, which is all about, again, securities, the stock market, the bond market, all these sorts of things. And we are going to be covering today the rate of return exercise. That's due on the 19th. I'm going to cover that exercise in class today, so definitely have something on your desk to take notes with, because I'm going to show you guys how to do this. Wednesday is going to be kind of our 0 hour. I'm going to ask you by the end of class on Wednesday to please email me your 3 to 4 stock picks. So what are you going to play in the markets and why? So think about why you're picking the stocks you are. We're going to gather into groups on Wednesday, but I'm encouraging you before then maybe to check out the markets. So, but let's get in for today, guys. Guys, please have something on your desk to take notes with for this, because I'm going to be covering a lot of this stuff. Good morning. Guys, these are our stock teams. Everybody is currently in a team, and I think I got them right. I love the names. I can't wait to see what you guys pick and which way you're going to go. Actually, let me ask you guys. I'm going to call on each team and just tell me at this point in time if you have a strategy. If you don't have a strategy, that's totally okay. But the 4 Musketeers, what's your strategy? You guys going big risk or you going diverse? Which way you guys going, 4 Musketeers? Yet to be determined. That's okay. How about the top 4? What's your strategy, guys? That would be Paige, Kobe, Tracer, and Sean. What strategy are you guys thinking? Are you going aggressive? Are you going conservative? Are you going to mix it up? Mix it up. Diverse is good. How about Strat and Oakmont? What's going to be your strategy, guys? I love it. All right, so we're going to try to go aggressive. The Friars of Wall Street. Love the name of this group. Which way are we going, guys? So we're going to mix it up. We want to make sure we don't lose everything. Okay, and chasing failure. I love it. What's your strategy, chasing failure?
We don't know yet.
That's okay. You know what? It's okay not to know, because that's how we learn. Guys, we left off talking about primary versus secondary markets. When is the only time you can buy a stock directly from a company? It's an acronym. It sounds an awful lot like a delicious beer, but it's not a delicious beer. What am I talking about? It's an IPO, initial public offering. That's the one time you can buy a stock directly from a company. IPOs can sometimes be big, sometimes they can be small. It's unpredictable. For example, some companies have had less than stellar IPOs and had good lifetime performance. Some have had great IPOs with lots of buzz and never went anywhere. So how does this stuff work, guys? We've got the secondary market, which means anytime you're not buying direct from the company, you're buying from the secondary market. You can buy from a broker or you can buy from a dealer. Here's the difference between these two, guys. We've got national and regional exchanges on broker markets. So if you're buying from a broker, whether you're buying from somebody who's an online broker or whether you're buying from an actual physical stockbroker, they still exist. They're an endangered species, but they're still out there. You're buying off an exchange. So we've got, for example, regional exchanges in big cities like Boston and Chicago, but the big one. Write this down, guys. The biggest exchange in the world is still the New York Stock Exchange. Write this down. The biggest exchange in the world, write this down. is the New York Stock Exchange. That will definitely be a question on the test. But we have other stock exchanges as well. Then we get into dealer markets, guys, and this means, for example, we're getting into automation. More where computers are doing the trades. NASDAQ is the first example of this. Write this down. The first electronic stock market was NASDAQ. We're going to talk about the NASDAQ. NASDAQ was the first electronic stock market, but get this. It's also a publicly traded company. So one of the companies where you can actually buy stocks from dealers is itself a publicly traded company. So yeah, it gets a little complicated. We're covering this in a very kind of high level because when you get into your finance classes, you're going to dig more into the dirt on this stuff. But just know that the two ways you can buy stocks in the secondary market are broker markets, dealer markets. Yes, sir. NASDAQ came to life in about the 1980s, and we're actually going to cover a little bit about their history because back then, in the 80s, what didn't we have yet? We didn't have the internet. Although technically the internet's existed since the 1960s, we didn't have public access to it really till the late 90s, mid to late 90s. So this stuff was all done over telecommunications networks, phones and modems. Here's a little trivia for you guys. How many of you in your lives have ever experienced dial-up internet? Oh, it was a terrible time. Right now, even the slowest day at St. Francis on the internet was better than our best day. If you downloaded an MP3, this is my grandpa speak for the day, back when I was your age. Now actually, if you wanted to download one MP3 on a dial-up connection, it would take you anywhere between 5 and 15 minutes. That's how slow the internet was. And that's what we were doing these kinds of exchanges on back during those times. But let's talk about the different ways in which you can buy stock. You have two options, generally speaking. You have common stock and preferred stock. If I said we have common and preferred, which sounds more exclusive? Preferred. You got preferred stock. You got preferred seating. You got preferred parking. You got all these luxury things. In reality, preferred stock means you are giving up your voting rights in exchange for a guarantee that if there is a dividend that's paid, you'll get it first. They're basically buying off your vote. By the way, guys, that cologne was an actual cologne in the 1980s called preferred stock. Because the 80s, because how many of you have seen The Wolf of Wall Street? Yeah, it was all about the big bucks. And we even had our cologne, preferred stock for men, that represented the stock market. So remember this, guys. If you have common stock, you got rights. You got voting rights. If you have preferred stock, you are giving up your voting rights in the hopes that you will get paid earlier than everybody else. Okay. So what are these things? What are these terms? If the company is making a profit, a publicly traded company is making a profit, they can choose to pay you a dividend. Is it a legal obligation? Nick is correct. It is not. It is not a legal obligation. But let's say, for example, up here, this front row, we're the board of directors. And our company is making money hand over fist. Our stock is going up. Company is doing well, and we've decided we've made some profit this year. And guys, I think we've all decided we're not paying a dividend this year, right? We're keeping that money in the company. You guys with me? We're keeping our money. How do the rest of you guys feel about that? Are you happy that we're not giving you some money? Cameron's shaking his head. No, I think he's actually going to come up and hit me, I think. But actually, people think about it all the time. It hasn't happened in class yet, but hey, the day ain't over. Somebody may punch me out before the day is over. You're going to be ticked at us for not paying dividends. If we keep doing this, you're going to say, what the hell? Why are we investing in the stock if we're getting nothing out of it? You could either sell your stock, in which case there could be a perception that the company's not doing well. What else could you guys do to us, the board of directors? Well, that's a possibility, but what else might happen? Because you guys are shareholders. What happens? We get voted out because you guys are saying you guys are bums. You're making money and you're not sharing it with us here. We're voting you out. Then we have what we refer to as retained earnings. If we choose not to pay a dividend or not pay all our profits and dividends, we can reinvest into our own company. And we're going to talk a little bit more about this in a second after we cover the term venture capital. Who here has ever seen the TV show Shark Tank? Tell me, when they give companies money, what do they want to see? if I am one of the guys who's handing out the money in Shark Tank, what do I want in exchange? I want shares in that company. I want control. Venture capital means somebody is giving you money to spend. It's not a loan. It's asking for a share in your company. So technically, venture capital is still equity. Remember that term. It's not a loan, it's equity. Venture capital is equity. But let's talk a little bit about retained earnings a little bit. I mentioned this early in class. Does anybody remember? For every dollar that Sheets makes in revenue, how much is actual profit? How much? It's 1 cent, because they're using the retained earnings to reinvest in their company. Companies do that when they want to grow. It's a risky move because you want to keep your shareholders happy, but the trick is Sheets a publicly traded company? They are not. So they can do that much easier than somebody like Amazon can do it. Although people let Amazon off the hook for a long time with that stuff as well. So what kind of stocks are there, guys? We have growth stocks. Guys, growth stocks are all over the news these days. What is everybody and their brother in the pharmaceutical industry hoping to develop? Everybody wants a COVID vaccine. If you're the company who can make that happen, you're going to make some bank. It is a big risk. A lot of people have claimed to have progress, but not a lot of people have anything much to show for it. If you want to be in the stock that develops a COVID vaccine, you got a hot stock. But these are very volatile stocks. Technology. Yes, sir.
I have a question about the medicine. Are there certain stocks that people have invested in because they think they have a cure cancer?
Oh, absolutely. When you think about it, guys, when I say this, please don't think I'm belittling anybody's illness, because we all know people who have had cancer or have had HIV or had all these terrible illnesses. If you're a company that can come up with a cure or a treatment for those, yeah, you can make an awful lot of money. And here's one of the things, too. The reasons why sometimes those medications are so profitable. In the United States, a lot of companies will sell at a higher price than they do in other countries because insurance will offset the cost. So it can be very profitable, too. There's all kinds of ethical considerations there. But if you're getting into the big diseases, if you're getting into cancer, if you're getting into diabetes, if you're getting into, at this point, COVID, back in the 80s, 90s, HIV, any of these chronic illnesses that kill people, yes, you can make some money in that market as well. But they can be risky investments for a lot of reasons. Number one is it takes a lot of money to develop these medicines. And if you put all the money in and get nothing out of it, it's just wasted money. The other part of it is, too, once other competitors start developing competing cures, it's also a competitive market at that point. So here's something that's pretty interesting, guys. When we start thinking about the American public per se, first question, does anybody know, out of every $5 that moves through the American economy, how many of those dollars go to healthcare? It's not that high, but it's 1 out of 5. 20% of our GDP is spent on healthcare. The highest amount of any country in the world. We spend more on healthcare than any other country in the world. Because, well, actually, why do you guys think that is? What are some of the reasons we spend so much on healthcare in the United States? We're one of the oldest, and what else? Well, health insurance, too. That's a very complex thing. What else? We're the oldest and unhealthiest in the world. We have more cases of diabetes. We have more cases of obesity, things that kill people. And guys, if you look at this, here's a statistic for you. Has anybody ever heard of something called comorbidities? Here's what that term means. Somebody who has one serious illness probably has several. For example, somebody who has diabetes usually has high blood pressure. Somebody who has cancer, for example, may have other illnesses that go along with it. 5 sickest percent of the population use about 95% of the resources. So it's a very lopsided equation. And the investment in things like health insurance can be very risky for those reasons. Well, then we get into the second type of stock. Just remember, guys, those are growth. That means if something hits, it can hit big. Then we get into income stocks. And what we're talking about there are utilities, things that people always need. You can't generally shop for power, although electricity is a quote-unquote deregulated industry. In this area, you can buy electricity in Pennsylvania from whoever you want to buy from chances are one company actually owns the transmission lines. So it's really still sort of a monopoly. So if you're buying stocks and utilities, for example, the rate of return on these tends to keep up with whatever the pace of inflation is. So when inflation makes prices go up, the gas company raises their rates. The electricity company raises their rates. It's a good place to put a part of your investment. Then we get into penny stocks. Guys, these are stocks that are very risky investments. It doesn't cost you a lot to get in, but you've got to buy a lot of them because they're really cheap. We say penny stocks, we're talking literally like a penny to a dollar to a couple of dollars. From the folks who watched The Wolf of Wall Street, how did they sell their stocks? They definitely lied. But like right now, for example, I could go online and buy a share of stock from whatever exchange I wanted to use. I happen to use Chase for my transactions or Robinhood. How were these guys selling stocks? They were calling people up literally and looking through a book saying, hey, this is a stock for you. This is something you want to use. Here's what I want you to know. Write this down. Penny stocks are not listed on exchanges. They are not important enough. They're not guaranteed enough. They're not viable enough to make it to an exchange, and they're called a penny stock for lots of reasons. Then we get into blue chip stocks. Blue chips. Do I have any poker players in here? Yeah, you always want blue chips, don't you? Blue chips are meaning good, solid investments. They're not always 100%. Some of the biggest companies in the United States are blue chip stocks. Lockheed Martin and Northrop Grumman. Does anybody know who those companies are, what industry they serve? Department of Defense. They basically, the two biggest players, companies like that, basically always make money. General Motors generally is a blue chip stock, although they've had their ups and downs. And then we get into a company, actually, guys, what is the biggest exporting non-military company in the United States? I'll give you a hint, airline industry. Good guess. I'm actually thinking of a manufacturer. Boeing. Boeing is the biggest exporting company in the United States in terms of total profitability. You want to know why people are freaking out about the airlines shutting down? It's not just the airline workers, it's the companies like Boeing. Boeing has generally been a blue chip stock. Yes, sir?
So those blue chips, they're typically worth a lot.
They typically are characterized by a higher stock price and more consistency over time. Like, let me give you an example. And this is not, when I say this is not 100% because nothing is in the stock market. But even during a recession, are we still spending money on defense? Yeah, you're still building planes, you're still building bombs, you're still making stealth bombers, and big Department of Defense companies like that are still going. In fact, sometimes they even make more money during recessions. Yes.
So is it like a greater job for a company like Boeing when that whole thing with the one certain type of plane and that whole thing happened? Like, did they have like a great drop when like all the planes had to land and they couldn't fly those certain planes for a little bit?
Absolutely, because they're not manufacturing. Like, let's say, for example, we're talking about, I think, was the 737? 737. So all of a sudden we're finding out these planes are crashing, just dropping out of the sky. And you guys are airlines across the world who put in orders for those planes. Do you want those planes now? Yeah, nobody wants their customers to die. And so all of a sudden those orders get put on hold. And those orders, by the way, guys, it takes time to make one of those planes. It takes resources. That's big business. And here's the other reason, guys. If you're Boeing, let's talk about the impact here. We just stopped the whole 737 production line for 6 months. In addition to our employees, who else is getting hit? What are the landing gear on a Boeing made out of? What are the tires made out of? They're made out of rubber. They don't make those tires. They buy them from a supplier. A lot of the electronics in the plane, they don't make that either. They buy it from a supplier. A lot of the work that goes into things like upholstery inside, the seats, they buy that stuff from a supplier. So that's a downhill effect. So what I'm telling you guys right now is the reason we should be concerned as Americans about things like the transportation industry is it doesn't just affect flight attendants. It affects everybody who makes stuff for the airline industry. And the predictions are with even if we had a cure to COVID right now, It'd still take us 3 to 5 years to recover to get back to the travel levels we were at back in February. So that's the stuff to think about. Here's the other trick, though, guys. Could it be, if you're looking long term, I'm not saying for the stock game, if you're looking long term, could it be an easy time to snatch up some shares of Boeing? Yeah, you can get it on the cheap, most likely. So what are pros and cons of stocks, guys? The pros and cons are, well, it's easy to raise money. You improve your balance sheets. You basically get free money infused into your company, and you don't have to pay dividends. Here's the bad part, guys. Anytime you sell stock in your company, you no longer have total control over your company anymore. Your shareholders are the people who are making decisions. If you're not paying out dividends, you might get voted out. Anytime you make money, write this phrase down. When you make money, you get paid a dividend, you get taxed on it. That's called a capital gains tax. And a company, their income is taxed twice. Whatever they're making in profit gets taxed. Whatever shareholders are getting paid out in dividends gets taxed. So you're getting taxed twice. Any questions so far, guys? We're moving pretty good today. I'm sorry? With capital gains, yep. I'm going to leave that up there for a minute before we get into the rate of return exercise. Because I'm actually going to walk this through with you guys, and we're going to show you how to calculate if you're making money. Yes, sir?
Is that I read from econ, we learned about the sole proprietorship and partnership. You don't get taxed twice.
Yeah, because if you're a sole proprietorship or a partnership, as long as you're not publicly traded, as long as don't have a public stock, yeah, you're just getting taxed for your normal.
But then as soon as you become a corporation.
You got it. In fact, in a later chapter, we're going to cover the different types of corporations because there are different ways to get around that. For example, if you are something called an S corp, you can limit yourself to 100 shareholders, and you can choose how you want to be taxed. But we'll talk about that now. That's an excellent question. Any other questions, guys? Before we get into our rate of return exercise, does anybody have a question or comment about anything? Question or comment about anything, guys? I have a question for you guys. What was the best part of your weekend? What was the best part of your weekend? Yes. Wow, like you were at that game?
Yeah.
Wow. Now you're an Eagles fan, though, right?
Yeah.
Yeah. So you can't win them all, right? But I mean, was it fun? How many people were in the stadium?
It was pretty empty.
That's
Wolf said 7,500.
Do you know how many Steelers fans would have fought you for those tickets too? That's awesome that you got tickets. Who else had a great weekend? Tell me something good that happened this weekend. I'm going to walk around randomly because we need to get some conversation going. What's something good that happened this weekend?
I watched football game.
And remind me, who's your team? How'd they do? Yeah, well, the Washington football team. The Washington football team. Tell me something about your weekend. Something good. Who did you see? I should notice what you're sure. How'd they do this weekend? All I did was grade this weekend. I didn't get to watch any television. I was grading all weekend. Tell me something good that happened this weekend. The Lakers your team? So it's a good weekend for you, right? Yeah. Tell me something good that happened this weekend. Sleeping in, man. I wish I could have done more of that. That would have been awesome. So, guys, just remember, we are on the downward slope. We're on the other side. We crested the top of the hill. So it's all downhill from here. Guys, what I'm about to do is to show you a key part of how you're going to do so well on your paper in this class for the stock game. I'm going to show you how to do a rate of return. You're also going to be doing something very similar to this for your next assignment, the one that's due on the 19th. So if you pay attention to what happens here, you'll get a perfect score on an assignment that should take you about 10 minutes to do total. So bear with me here, guys. We have $100,000, and we're choosing to invest it into 2 stocks. Well, for purposes of this assignment, we're going to do Harley-Davidson and Ford. All right, so we decided for whatever reason, because we're crazy, because Harley's not doing well in reality, we decided we're going to put 60% of our $100,000 into Harley-Davidson. 60% of $100,000 is $60,000. We have Ford. And Ford, by the way, I think Ford may stage a comeback in the next year. I bought some shares of Ford. Why am I excited about Ford right now? It's the new Bronco, the new Bronco SUV. And people my age, for example, have a very affectionate attachment to that nameplate. So I think they're going to be selling a lot of Broncos. They're going to fight the Jeep Wrangler with the new Bronco. So we're going to put $40,000 into Ford. Those are the maximum amounts we can invest. Can we buy partial shares of stock? We cannot. Typically speaking, we'll talk about some exceptions to that rule, but when you're buying stocks outright, you can't buy a partial share of stock. So let's figure out, let's say, for example, Harley Davidson at close on the 1st of October was trading for $50 a share. At close on the 1st, Ford was trading for $9.50 a share. We know for Harley, for example, we're putting 60% of our 100,000 into this. If we divide 60,000 by 50, we can buy 1,200 shares. And look at this, guys. We actually spent the whole 60,000. You are hardly ever going to get an even number for a stock price. It's going to be $50.42 or $49.48, something like that. But for purposes of this exercise, we spent the whole $60,000. We got Ford on the first close. We're buying it for $9.50 a share. So $40,000 divided by 950 means we've got 4,210 shares. We spent $39,995. Here's the key thing to recognize when we do our calculations. Did we spend all $100,000? We did not. So when we divide, we're not going to be dividing by 100,000. We're going to be dividing by what we actually spent, which was $60,039,995. With me so far, guys? Well, we decided for 1 month we're going to play the markets. So on the 31st, although it should be the 30th because the 31st is a Saturday. On the 31st, we sold Harley, and we made $3 a share. It was $50 when we bought it, and we sold it. It was $53 a share. So if we take 53, the final price we sold at, minus 50, we made $3 a share. Pretty good. We're going to take that $3 times the number of shares that we made, or that we purchased rather, and that gets us $3,600 that we made. Not bad for a month. And we're going to divide $3,600, which is the amount of money we made, by the amount we invested, which is $60,000, and we're going to get 0.6 rate of return, 0.06, 6% rate of return. So to recap, how much money you lose or make per share, multiply that by the number of shares that you bought, and divide that by the amount you actually invested. That gets you your rate of return for Harley Davidson. Well, things aren't so rosy at Ford. We sold this stuff for less than we paid for it. So we bought it at $9.50 a share. We sold it on the 31st. We sold it for $9.25. So we lost a quarter on every share. If we take a quarter, and it's a negative 0.25 times the number of shares that we purchased, which is 4,210, we lost 1,052.50. Not good. We take that, we're going to divide the negative number, so negative 1,052.50 by 39,995, and that gets us a 0.026 or a 2.6% negative rate of return. So your rate of return will be either negative if you lose money or positive if you made money. How many of you have decided in your stock portfolios to go diverse, to do high and low risk? Raise your hand. Seriously, if you're thinking that way, it's a smart move. It's a smart move, and I'm about to show you why. Because right now, what we're going to do is figure out our whole portfolio's rate of return. So right now, if we take what we made or lost on each of these stocks. So for example, to recap, Harley Davidson, we had a total of $3,600 that we made. We made $3,600 on Harley. We lost $1,052.50 on Ford. We take one from the other, we still made money. We made $2,547.50. We're going to divide that by how much we originally invested. Did we invest the whole $100,000? No, we didn't. So we're going to add what we did invest. We put $60,000 into Ford. We put to Harley, and we put $39,995 into Ford. So $60,000 plus $39,995. And we're basically going to divide 2547 by these figures combined, and we are going to come out with a 2.55 rate of return. Does that make sense, guys? I want to hit a couple of points here. This is always where people screw up. You guys have $100,000 to invest. I know I'm being repetitive, and I know it's a Monday morning. Can you possibly, let me rephrase that. Is it likely you will invest the whole amount? Hell no. You're going to come up with an odd number. So what you are going to do is divide by the amount you actually invested. Second thing, take your decimals out on these calculations to at least 4 points. And you can round at that point. But take it out to at least 4 points. Because if you have enough shares of stock, a percentage point or a partial percentage point can mean a few bucks. So take it out to 4 points. Any questions, guys? Because here's what we're going to do. When we get together again on Wednesday, for example, we're going to do this math again because I want you guys to feel comfortable. Any questions so far? It's a Monday morning. All right, well, because it's a Monday morning, we're going to keep asking questions here, guys. How many of you like ghost stories? How many of you like Halloween? A few folks. All right, well, it's not official yet, but it'll be official later today. The last Wednesday of this month, we're going to have a ghost storyteller. His name is Dr. Kirk Wexel. He's a professor emeritus here at St. Francis. He's going to be coming to a fire pit behind campus ministry, and we're going to spend the evening hearing ghost stories about this region. Some of you, for example, in the Enactus meeting heard about things like the White Lady of the Buckhorn. There's also a haunted mansion in Altoona called Baker Mansion, where a wedding dress supposedly comes to life on Halloween night. There's all kinds of ghost stories in this region. So we're going to be doing that stuff on the last Wednesday. In fact, I'm even going to get that CES approved. So if you need CES, you can get it for coming to see some ghost stories. But let's continue a little bit here, guys. Bonds are the other end of the equation. Stocks, for example. Are you legally required to pay dividends? You're not. If you have a bond, you got to pay interest. So some of the good parts about bonds. If I borrow money from somebody, for example, yeah, I got to pay it back. I got to pay it back with interest. But it comes down to the fact that they don't have control over how I'm spending that money. If I go to a bank and borrow a personal loan, for example, I can use that money for whatever I want. Now, anytime you have a bond, it just means you've got a loan. Your interest rate means what rate do you have to pay your money back at. Let's say, for example, we have a couple folks in this room. Like Maxwell and I both go for loans. He's got an excellent credit history, and mine's terrible. He's paid back every debt he's ever had. I owe 17 people money, and some of them are never going to get paid back. Who's getting a better interest rate? Yeah, Maxwell's getting a way better interest rate than I am. So generally speaking, if you've got good credit, you're going to get a loan at a better rate. It's the same with bonds. If we are a company that borrows money and pays it back, we'll get a better rate. And typically speaking, the higher your bond rating, the lower the rate. Now here's the thing for you as investors. If you're investing in a bond, the more secure the company is, the lower the interest rate. So if you're taking a more sure thing investment, you're going to be getting a lower interest rate. So security, basically we're talking about collateral. If I'm a high-risk company, for example, I might have to put something up as collateral. What would be an example of something a company might have to put up as collateral to borrow money? What do you think? What's something that you might have to put up as collateral? If you personally were borrowing money, if you want to borrow $10 from me, what could you put up as collateral? Yeah, absolutely. I wouldn't put up a house for $10, but you could. Yeah, it's that's a pretty good risk for me, I think. It could be your assets, it could be your cars, it could be your buses, it could be your factories. You're putting up physical things as collateral. Unsecured loans means you don't have to put up any collateral. Typically speaking, those are smaller loans. Now here's another term to remember when we're talking about loans. If something is callable, that means you are allowed to pay it off early. Why would you want to pay off a loan early? Yes? You're getting out of your interest. That's why, for example, when you guys get out and have your student loan payments, if you have credit card debt or you have student loan debt, which should you generally pay off first? I think credit cards. Why is that? Anybody know what the average credit card rate, the interest rate is in the United States? Any guesses? Take a guess. Humor this old man on a Monday morning.
1.8,
Oh, keep going.
3.6.
Go over 15. A credit card, the average credit card interest rate in the United States is over 20%. What that means is a person who has $4,500 or more in credit card debt, the average American, will never pay it off. So pay your credit cards off first. The average student loan interest rate can go anywhere from about 1.8 to about 6%. Although they can get bigger, they can get smaller. That's what we call good debt. It's investment debt. Pay it off over time. Get rid of those damn credit cards first. Credit cards are, in essence, unsecured debt. So if we pay it off early and save on our interest rate, we're talking about callable. Here's the other one. We have convertible debt, for example. Let's say, for example, I put out a bond. Instead of paying it back, instead of paying you guys back, I give you a different option. We're a publicly traded company already. I'll give you shares of stock instead of paying the loan back. Then we can convert that into shares of stock, and that's how I will pay it off. So convertible. Should say, how about some stocks instead? Not bonds, but stocks. So convertible bonds means you can pay off by giving people stocks in your company. Some of the other kinds of bonds that we have, guys. Municipal bonds are how a lot of local municipalities actually finance and support the government. They basically borrow money. You can lend money to a municipality, a town, a city, and that's how they do infrastructure upgrades. Then we get into all of these different types of U.S. Treasury bills. For example, if you are going in for 1-year Treasury bills, you don't really make much money on them. You're doing that to be patriotic. Yeah, I'll buy some Treasury bills. I'll get my money back out. Maybe I'll get a 1% interest rate, but they're not really very valuable. It's a patriotic thing to do. Then we get into Treasury notes, and they can mature in about between 1 and 10 years, and they have a fixed rate of interest that changes every 6 months. You make a little bit more money on those. Treasury bonds, you hold them for 30 years, you can make some money. Interest rates on those can go up. You're not generally going to get even close to 10% on those. And then you get Treasury inflated protected securities tips. Those are based on a consumer price index. And that means anytime the consumer price index goes up, the price, it's an average of things that people are buying every day, like food and normal supplies. Those Treasury inflation protected securities, basically their interest rate goes up as the CPI goes up as well. The biggest thing I want you to know on this slide, because this is not an investing class, is that generally speaking, the longer you hold government debt, the more money you can make on it. So, what are some of the pros and cons? Guys, actually, you guys tell me. You have the option of raising money for a company with either selling stock or issuing a bond. Which would you do and why? Yeah, if we had the option, and you've got a company, and you need to raise money to be able to expand your company, would you issue stock or would you issue a bond? Would you sell shares of stock or would you borrow money, and why? What would you do? Tell me why.
Because it's more reliable and you're sure to get your money out of it.
So we are more reliable because the interest has to be paid back. It's on a schedule. Okay.
Stock can inflate pretty easily. When the company does something bad, it can shoot down.
So you
You lose money.
can lose value very quickly. And in terms of control, guys, and which scenario, on a stock issuance or in bonds, in which case does the company maintain more control? In bonds, because you can borrow the money, nobody can tell you how to spend it. You are legally obligated to pay interest on your bond. However, you can tax deduct it too. So if I owe somebody money on a bond and I'm paying interest, I can deduct that interest. If you are selling stock, you, for example, are going to get taxed twice. And so, again, it looks bad on a balance sheet if you're in debt. Stock looks better on a balance sheet than bonds typically do. What questions do you guys have? Because we're going to talk repeatedly about the differences between these two. I think, however, this is a good place for us to end our conversation for the day. Guys, before you leave, number one, on Wednesday, we're going to be picking stocks in this class. If you already know what stocks you want, talk to your group about it. But before we leave here on Wednesday, you got to tell me what your 3 to 4 stocks are going to be. All right? See you Wednesday.